What's up, traders? So today I'm going to tell you about two stocks that I think can outpace the market over the long run, especially seeing as they both had earnings this morning, and I'm going to show you a possible trade for both. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market, and I use the money I make from the stock market in order to pay for my entire lifestyle. Now, as always, the first things first, go ahead and smash that like button right down there and hit the subscribe button. And do remember that I am not a financial advisor, and this is not financial advice. All trading comes with risk. I'm just showing you how I build wealth over time. Now, the first stock is none other than PayPal. And I'm sure you're familiar with PayPal, but if you're not, they simply provide a safe way to make payments online, and they also allow you to send money to and from friends and family. But they just had earnings this morning, so let's see how it went. PayPal Holdings on Tuesday reported March quarter earnings that topped Wall Street estimates while revenue fell short. The company maintained its full-year earnings guidance for PayPal stock amid growing investor worries over a possible U.S. recession and a U.S.-China trade war. PayPal earnings for the first quarter rose 23% to $1.33 per share on an adjusted basis. Revenue climbed 1% to $7.79 billion. Analysts expected PayPal earnings of $1.16 a share on revenue of $7.85 billion. In a bright spot, active monthly users of digital payment services rose 2% to 436 million. All right, so earnings grew 23% and revenue grew by 1%. Now, an opportunity that PayPal is currently venturing into has me pretty excited about it. And that opportunity is digital advertising. And we can see that they just announced this in October of last year. And I believe they started the initial rollout in either November or December. But it says here, payments giant PayPal formally rolled out PayPal Ads. Its business set to debut during the upcoming holiday shopping season at Advertising Week, New York. The move marks PayPal's entry into the competitive digital advertising space, harnessing its vast user base and transaction data. The key selling point, of course, is access to 400 million PayPal users, 90 million Venmo accounts, and millions of Honey users, combined with data from 225 billion transactions across millions of merchants. All right, so this digital advertising can be a huge stream of revenue for PayPal. And I believe due to this and having over 400 million active users that advertisers can consistently advertise to will help it tremendously over the long run. And this is just one of the changes that the new CEO is making. But let's go ahead and dive a little deeper into their fundamentals. All right, so PayPal, ticker symbol PYPL, is currently a $64 stock. However, it is up pre-market after earnings, and it's up about 1.32%. Now, the market cap is 63 billion. And here's what I like here. The PE ratio is 13.99. So let's just say 14. That is super cheap. And here's the thing. So looking back at the chart from 2021, you can see that it dropped tremendously because it was near $310 back then. But for some reason, this stock is perceived as a dying company. However, when I look at the fundamentals, everything is growing. So it almost makes no sense at all. You can't be a dying company, but your numbers are increasing. And this reminds me a lot of Meta, aka Facebook. In 2022, the stock kept getting sold off and they kept advertising it as a dying company and saying TikTok was going to take over all of its users and nobody uses Facebook or Instagram anymore. And for all of 2022, it just continuously sold off. And what I did then was I looked at the fundamentals and I said, this is a mistake. The market is pricing the stock as if its value is here, although its value is here. So there was a clear price discrepancy. So during that year, I actually made Meta my largest holding. And in 2022, the stock dropped all the way down to $88. And then over the next several years, it went all the way up to $700 something just earlier this year. And I'm seeing that same price discrepancy in PayPal. So let's dig a little deeper. So looking at their income statement over the last 5 years, we can see the year ending in December of 2020, they did 21 billion and they pretty much grown it every single year. And then the year ending in December of 2024, they did 31 billion. So over the last 5 years, they've increased their revenue by 50% and added $10 billion to it. Now, does that sound like a dying company to you? I don't think so. Now, looking at their net income, they have been stagnant. So in the year ending December 2020, they had 4.2 billion in net income. And in the year ending December 2024, they had about 4.1 billion in income. So it's been pretty stagnant. However, that's more of a management issue than it is a demand issue. And so since they do have a CEO that is making changes, I absolutely expect this to change. And as we just seen from their earnings release, their earnings went up by 23% year over year. So that change is in effect. But that is exactly what you want to see from a company, is their revenue continuously growing and the bar is looking just like a staircase. And based off of my fundamental analysis, I am a buyer of PayPal anywhere under $70. So I think I want to sell puts against it in order to buy the stock at a cheaper price and get paid to wait. So really quickly, let's discuss selling puts. So when you sell a put, there are two main objectives, and it's one, to generate income, or two, to buy the underlying stock at a cheaper price. So when you sell puts, you either one, want to make money, of course, and or two, you want to buy the stock at a cheaper price. And selling puts is literally like selling insurance for stocks. And here's what I mean. Let's say I have ABC stock that is currently trading at $100, and I like the company and I want to purchase the shares. So I could potentially sell a put at, let's say, $90. And as I'm selling a put, I'm essentially saying to the buyer, hey, I will buy your shares of ABC stock that are currently trading at $100, and I will buy them from you if the stock crashes below $90. However, for doing so, you have to pay me, let's say, $200 right here, right now, and this contract is only good for the next 30 days. And from there, two things can happen. Let's say ABC stock stays above $90, then we just keep the $200 we were paid and we go about our day, and we can do that trade over and over and over and over again. However, scenario number two is if ABC stock drops below $90, then we still need to purchase the shares of ABC stock at the $90 that we agreed upon. However, we still keep that $200 that we received. And so as a put seller, you are essentially selling insurance for the stock. And just like with your car insurance that you pay every single month, the insurance company keeps the premium that you pay them whether you get into a car accident or you don't. And so here's a quick example of selling a put with a real stock. So let's say Apple stock is currently trading for about $220. And let's say you're interested in buying Apple stock at a cheaper price. Then what we could do is we could sell a put, let's say at $200, and that would be our strike price. And we could select an expiration that is 30 days out. And for selling this put, we would receive $150 immediately right here, right now. And so if we look at this profit and loss chart over here, so Apple stock is currently $220. If the stock price were to go up, then we just keep the $150 we received. If the stock price stays the same, then we just keep the $150 that we received. If the stock price goes down some, we still keep the $150 we received. However, if the stock price dropped below our $200 strike, then we will be forced to buy 100 shares of the company per contract that we have. And that's literally how selling puts works. However, now let's go and take a look at the few data points that I look at prior to selling puts. Now looking at PayPal stock, you see it's been in for a nice little ride over the last year, where it was as low as about $58 last June and July. And then it went all the way up to, let's see, about $93 in December. And then it had this nice little sell-off recently, which most stocks have due to all of the tariff news. And it went as low as $55. But now you can see it's starting to recover again. And so the first data point that I like to look at prior to placing any trade are the Bollinger Bands. So the Bollinger Bands are these black lines up here, but they simply aim to show you the range that a stock is expected to trade within. So we can see here, the Bollinger Bands have it at a low price of $58.94 and a high price of $65.79. But since we are selling puts, the number that we want to pay attention to is that $58.93 mark. Okay, but now that we have that information, let's head over to the next data point. Now, when I'm selling puts, I will go up to 45 days out. So if we take a look at our expirations, let's go ahead and use this date that is 39 days out from now. And it shows that it currently has an expected move of $6.51. And so with that, on the lower side, that would be $58 as well. So both the Bollinger Band and the expected move is using $58. Now, with that being said, because it's already under the price that I am comfortable with purchasing the shares at, I may decide to be a little bit more aggressive. And that is good to know. And if you want access to this data, I use barchart.com. However, if you use the link below in the description, you will get your first 30 days for free. So go ahead and use the link below in the description, try it out, see if you like it. I use this website every single day, and it helps me make better decisions on my trades as there is a ton of information all in one place. So go ahead and try it out. But let's head on over to Thinkorswim and look at our very last data point. All right, so now we're here at the options chain for PayPal. And now I just need to simply select the date. And we said the date that was 38 days out from now. And the last data point that I like to look at is the delta. So we can see the delta right here. But by definition, the delta is how much an options premium will move per a $1 move in the underlying stock's price. So we can see here at this strike of $64, it is a delta of 0.38. So that is saying that the options premium will move 38 cents per a $1 move in PayPal stock price. Okay, but most successful investors that I know would use the delta as the probability of the event occurring. So to me, that is saying there's about a 38% chance that PayPal stock price, which is currently at $65, drops down to that strike price by the expiration date. And so typically with deltas, I like to go to a delta of 0.20 or lower. However, when a stock is already near my buying point, I will go up to a delta of 0.30. So if we look over here, that would probably put me at this delta of 0.28 right here, which is the $61 strike. And it looks like the bid and ask price is $1.50 to $2.28. So we would likely receive somewhere in the middle of those two prices. And to me, that would be amazing to possibly be able to buy PayPal stock at $61, seeing as I am fine with buying it anywhere under 70. So I can potentially get a stock that I really want at the price that I want it at, and I will get paid to wait around. So that sounds like a deal to me. So I'll go ahead and select the bid price, and your brokerage will automatically load up your ticket for you. And from here, you just need to select how many contracts you would like. But just keep in mind that you are agreeing to buy 100 shares of the company per contract that you have. So at a $61 strike, I am agreeing to buy $6,100 of PayPal per contract. And if the stock price is under my strike price by expiration date, then I will be assigned, aka I will have to buy the shares. However, if it's still above $61, then we go about our day, we keep the money that we were paid, and we can continue to do the trade over and over and over again. All right, and I've decided that I am personally fine with buying up to about $30,000 worth of PayPal. And so for me, that would be about 5 contracts. So I could put 5 there. However, I don't typically enter into my entire order all at once. I'll typically do about 1 to 2 contracts per day until I get to my max amount. But for the purposes of this video, I'll just go ahead and put 5 there. And we can see at the mid price, I'll get about $1.89, which means about $189 per contract. And if we look at the P&L chart, looking at that number there at the top left, we see I will receive $945 right here, right now for opening up this trade. And as long as PayPal either stays where it's at, I keep my money, go about my day. If it goes up, I keep my money and I go about my day. If the stock price goes down some, I keep my money and go about my day. However, if the stock price were to drop below our $61 strike, we can see I will start to make less and less money. And then my break-even point is right around $59.10. And now if it were to continue to go down more than that, then this becomes a losing trade. However, we were fine with buying the shares of the company at $61. So I don't care about any of this of it going down. I was fine with buying the shares at $61. So I am good to go. All right, but $945 to sit and wait around for a stock that you like to go on sale even more than it already is sounds like a win-win to me. But now let's take a look at the second stock. All right, so SoFi also had earnings this morning, and let's see how they did. So SoFi raised its full year guidance on Tuesday, with CEO Anthony Noto citing the fintech's growth in the March quarter. Quarterly earnings of 6 cents a share came in above the 3 cents a share analysts expected. Adjusted net revenue grew 33% to $772 million, marking SoFi's highest growth rate in 5 quarters and topping Wall Street's call for $739 million. The company saw strength across all its business segments, notably financial services, which grew 101% to $303 million in the quarter. So obviously SoFi is doing amazingly well, and I do believe that their business will continue to grow, but let's take a deeper dive into their fundamentals. So we can see SoFi closed yesterday at $13.20. However, it is up 6% pre-market, and it's currently about $14.11. And their market cap is $14 billion, and their PE ratio is 99. So that is pretty expensive. However, as we just read, they are growing their earnings pretty rapidly, which will bring this number down. And also when we sell puts at a lower price, that will help us out as well. All right, so looking at their income statement, we can see that their numbers are growing rapidly. They went from no revenue at all in the year ending December 2020 to now having revenue of almost $3.8 billion in the year ending December 2024. So we can see that growth illustrated in these bars over here. And the earnings are growing rapidly as well. We can see from 2020 to 2023, they had losing years. However, now they are comfortably within profit. So that is good to see. And the earnings release that they just had shows that their earnings are growing. So that is another positive, but let's dig a little deeper. So looking at SoFi's chart, we can see they've been in for quite the ride as well. It looks like from May to October of last year, it traded within the $6 to $8 range. However, in October, it went from about $8 all the way up to $18 on January 24th. And then from there, it sold off pretty much like every other stock has sold off at the beginning of this year, and went from $18 down to $8 again. But now it is bouncing back up. And so looking at the Bollinger Bands, it has a range of $9.64 up to $13.29. So we can see that it has popped out of the Bollinger Band now because of earnings, but typically when that happens within a few days, it bounces right back into the Bollinger Band. But that $9.65 mark is what we want to look at. So let's dig a little further. Checking out the expected move for the exact same expiration date that we use for PayPal, which is 39 days out from now. It has the expected move of $2.28, which at its current price will put it around $12. So we can go ahead and move into Thinkorswim and look at a trade for SoFi. However, if you are part of the Trade to Freedom community, you know we've been trading this over the last several weeks and we've made a ton of money off of this stock. But if you're not part of the community, if you know anyone that could use help generating income off the cash that they already have, then tell them about the Trade to Freedom community. The link is in the description below. But not only will they get to see my exact trades when I enter them, they'll get my full options framework via the Trade to Freedom course. They'll have full access to ask me questions at any given time, and they'll be within a community of other traders who all have the exact same goal as them. So if you know anybody, send them the link below in the description. But let's head on over to Thinkorswim. So here we are at the options chain for SoFi, and we'll go ahead and open up that expiration date that is 38 days out from now. And if we recall, the expected move had it at about $12, which would be a delta of 0.17. But let's say we're a little bit more bullish on this stock after the great earnings that they just had. So let's go a little higher to this delta of 0.22, which is the $12.50 strike. And if we were to sell a put on this, we would get anywhere between $46 to $68. So that is anywhere between a 4 to 5% return in just 38 days. So that is amazing. So let's go ahead and click it. Now, SoFi is obviously a much cheaper stock. And so since it's only a $14 stock currently, you can probably do more contracts on this stock than you could more expensive stocks. And so this is a favorable stock to trade for people who have smaller accounts. But let's come down here. Let's say I want to do 10 contracts here today. I'll go ahead and put 10 there. And it looks like at the mid price, I'll get about 45 cents. And then if we come down and look at the profit and loss chart, same thing as before. If SoFi stock stays where it's at, I just keep the $450 I was paid. If it goes up, I keep the $450 I was paid. If it goes down some, I keep the $450 I was paid. Now, if it starts to go below the $12.50 strike, then we will start to make less and less money, and our break-even point is right around $12.06. And if it were to keep going down, then this would become a losing trade. However, again, we were fine with buying the shares of SoFi at the $12.50 strike. And so when you have that mindset, there is no losing situation, because I'm getting a stock that I really want at the price that I really want. And I also got paid for waiting around. And lastly, even if it goes down and you are assigned the shares, you are down much less than the people who purchased shares today at the $14 mark, because you purchased the shares at $12.50 instead of $14. So selling puts gives you a huge margin of error. But those are two stocks that I truly believe will beat the market over long periods of time. And that is how I possibly plan on trading them. But again, if you know anybody who would like to generate more money off the cash that they already have, tell them about the Trade to Freedom community. The link is in the description below. Wishing you guys nothing but peace and blessings as you continue to trade throughout the year. But I will see you guys on the next one. Peace!